Good afternoon, ladies and gentlemen. You are welcome to the OTL 2020 session on Scaling Value for Oil Marketing Companies Post-COVID-19. Focus on technology. This session focuses on sustainability, adaptation, and realities of the new normal among operators in an industry that is on the threshold. The moderator for this session is Mrs. Bumi Agagu Adu, Company Secretary, Legal Advisor, Eterna PLC. Bumi is a barrister and solicitor of the Supreme Court of Nigeria with a demonstrated history of working in the oil and energy industry. She is responsible for the group's secretarial, legal advisory, and compliance functions. A graduate of the University of Nigeria, Nsukka, a qualified chartered secretary from the Institute of Chartered Secretaries and Administrators UK, she holds an MSc in corporate governance from the Leeds Beckett University, UK. Speakers for this session are Mr. Musa Lawan, Managing Director, Petroleum Products Marketing Company Limited, PPMC. Prior to his new position, he was the General Manager, Materials Management Division at NAPIMS. He was called to the Nigerian Bar in 1984 and joined the services of NNPC in 1987. His management roles have traversed insurance in upstream operations. Mr. Senyo Hosi is the Chief Executive Officer, Ghana Chamber of Bulk Oil Distributors, CBOD. He is a finance and economic policy analyst with management experience across varying industries, including downstream petroleum, industry advocacy, public policy development, finance, logistics, and commodity trading. He holds an MBA in finance and an MA in economic policy management from the University of Ghana. Mr. Avapfani Chifularo is the Executive Director, South African Petroleum Industry Association, SAPIA. Mrs. Laurentia Ndupu, Chief Operating Officer Downstream, Nigeria National Petroleum Corporation, NNPC. Mr. Olumide Adeosun, Chief Executive Officer, Ardova PLC. He has over 18 years of work experience providing transactional project management and strategy services both locally and internationally, covering oil and gas, power and renewable energy sector. He was a director at PwC West Market Area and a proven leader in conventional and renewable energy and corporate strategy. He's a member of the Petroleum Club, Oil Council, and Society of Petroleum Engineers.
A little clarification. Are you going to put up the slides, or you want me to put up the slides? Rightly on the subject, and I find this subject very, very important and critical at this time. At a time when the market is quite confused as to how best to approach or respond appropriately to COVID-19. COVID-19 brought in quite some huge confusion in the market. It disrupted a lot of things. Things like online demand, disruption in management, structures, practices, and systems, something that most people could hardly think of and then actually plan for. We've also seen major changes within the market with relations to things like prices. We've also seen disruptions in refinery margins. Every one of it affects the oil marketing chain. In Ghana, oil marketing is a bit different from what you have in Nigeria, but I'll be speaking about oil marketing companies more in relation to what you have in Nigeria, where your importers are also called OMCs. In Ghana, we do not call oil marketing companies, importers oil marketing companies. We call them bulk distribution companies. So my speaking will be one that merges the entire chain. And this is more to our listeners, from our viewers from Ghana. I'll first look at issues with demand. Generally, we've seen the African continent experience a massive decline in demand. Platts, in its recent reports, reported major drops in demand across most countries. You can see Gabon actually losing about 50% of its market on gasoline, 40% on diesel. Jets is very much the loser of this entire COVID-19 impact, largely because of the travel impact restrictions you have globally. This is not a matter of dispute. In Ghana, we have quite a very unique situation. We have volumes dropping significantly somewhere in March when we got hit by COVID-19 with our first case in the first half of March. And then we've seen a recovery. This recovery is not typical for what the recovery you see across the globe or the recovery you see across Africa. There are a few things that could be used to explain. There have been challenges with illegal trades and also had challenges with understated official volumes, which may be recovered in these times that probably account for it. But generally, there's been a major impact. COVID-19 and petroleum in our sector across Africa is driven by two key things: transportation and energy. Once you have disruptions in any of them, it has a positive or negative impact in the demand. If we have COVID-19 as it's done with lockdowns and restrictions and a quick advancement into virtual engagements like we are currently doing, there's definitely going to be an impact on transport fuels. That is a major driver on our market. I will not be able to say that much with power so far for Ghana in particular, and I'm not too sure that case is any different for Nigeria. But globally, we have observed or seen a major fall in demand. We've also had that cascading to the impacts on prices and margins. We've seen the demand drop, creating a supply glut, and that definitely forces prices down. We started the year with prices above 600, and currently we are somewhere around 400 and below 400 for most of the primary products that we actually use for our transport fuels and also for domestic power generation. Actually hits below 200 at some point for a product like an ATK, and below 300 for a product for both products as in gas oil and gasoline. Refinery margins have not gotten any better. On things like ULSD 10 ppm, we've actually moved from refining margins of about 16, 17, and we are barely struggling to even hit and keep a margin of 5. These create major disruptions in the entire sector. Low demand leads to asset underutilization, and that also have implications on profitability. Our gas stations that we have are not turning the volumes that we expect to. Stock holding periods are getting longer, and stock holding costs are also going to be increasing. But lower prices also provide us with a different view of things. It lowers our financing costs, which in itself is some kind of saving. But the supply glut also creates an opportunity for us as in maneuvering our supply chain dynamics. You look at low refinery margins, and it brings for me two key things into question: sustainability of West African refineries, which are already in a state of comatose. You have our discussion as a block through the African Refiners Association, looking at ways to advance towards cleaner fuels and expecting our refineries to also upgrade their engineering or their infrastructure to be able to provide or produce low sulfur fuels. But with margins depleting as they have, I think it's not rocket science to say that it's really much bleak a situation if we are looking at investments in our local refineries. Moving towards cleaner fuels will now become more of a dream than a possible reality. The disruption in management has also led to us needing to increase our efficiency, adopt remote management options, and for most of our oil marketing companies or bulk distribution companies, rethinking our labor. Bottom line, we need the numbers that we need. If most of us are going to be reacting and managing remotely, do we need the numbers that we need? That in itself also has a major problem on our socioeconomic dynamics as a region. But every problem comes with its own opportunity, either foster access into a future that beacons or has the possibility of also crashing us out. But as businesses, we need to thrive and we need to lead, we need to win. So the question, how do we root ourselves right to scale? We need to scale in our depth. We need to scale in our profitability nonetheless, because we can't just take a hit and survive down there. That is not a viable proposition. So I look at a few things, just 4 pointers on what I call a route to scale. One, as OMCs, we need to rethink our value proposition. We need to realize that while the product market is being disrupted, our customers and their needs are not disrupted. We continue to deliver a critical social service that customers would definitely need in our part of our world. And remember, Africa is supposed to be the next economic frontier, or the current one. But we do not position ourselves right, the opportunity will not really be at our own doors. It will be at the doors of others. So we need to give it real depth in thinking. The customer is our focus, not necessarily the products we sell. But we have a perfect opportunity to connect right with the same customer and have a stronger hold on that customer. So question, there must be a reason why you have Macy's in the US issuing credit cards to its customers. Can we leverage the service that we give, the apps that we would have to develop anyway to hold on to our customers and look at other value propositions that we could actually deliver to these customers through their need for the products that we sell? We need a re-engineering in our thinking and focus on customers' needs and just thinking of how we sell fuel to people. How do we optimize every dollar and make sure we can deliver value that can make customers continue to invest in our business? So we need flexibility in our approach to market. Number two, the market needs consolidation. There's a need for us to optimize our asset utilization. We are not going to be selling volumes as we used to. Beyond COVID, we all need to realize that there's a huge wave of change that beckons on our doors. Electric cars are going to be a key driver and a key influencing factor in Africa at some point in time. How prepared are we for that future? The remote activities that we have today, it's something that this world is destined to adopt. You're going to have a lot more virtual reality, augmented reality, AR, VR, every one of them are going to impact the demand and reliance on fuel. How do we stay strong even into that future beyond COVID? The fourth industrial revolution is being very, very disruptive. And we also need to change, or the market will change us someday. And that's why I think that there's a need for the industry to consolidate. So I propose these key things for us to start thinking hard. Sometimes at this stage where we have challenges with optimizing our assets, we need to look at how we actually merge and deepen acquisition options and vertical integration. Is there a need for us to have two gas stations across competing with each other and actually delivering little value to ourselves in this time that has a very low demand and possibly sustainable low demand into the future? I don't think that would be an optimal way to really approach it. Can we rather merge brands? These are things that we should start thinking of strategically. And it's a major challenge in Africa. We struggle with teaming up, but it is time for us to team up. Others who have teamed up would actually be the real frontiers of the economic frontier opportunity that is before us. Vertical integration speaks into the same thing. And my favorite, how do we compete? How do we cooperate in our competition? Do we all need to keep having depots? In Ghana, for example, we have a storage capacity utilization of about 0.2. That is grossly underutilized. Reasonably, you should be doing 1, but we're actually scoring 0.2. Yes, we are seeing investments in new depots because everybody wants to own one thing or the other. But there's very little wisdom in that. We must cease seeking to be village champions and find ways to cooperate to be able to try and compete as a bloc. Africa is up for the taking, and it's up to us to decide whether we will take it for ourselves or we are going to actually let Africa out to others. There's a need for increased cooperation. What we see Dangote do is a fantastic thing. How are we all thinking of cooperating and trying to leverage each other's advantage to deepen our ability to deliver consistent value to our people? and economic value to our businesses. Number three, we need to re-engineer our approach to market. There's a need for increased automation and digitization for us to thrive and survive into the future. COVID is limiting fiscal engagement, but that is a future that was going to come regardless. We can't continue to have our management practices, our assessment and monitoring of gas stations, of depots, by doing so much fiscal activity. For most of the regional depots, you see a lot of investment in technology that is constructive. So people can sit in their offices, see where stock levels are in depots, but you hardly see these things at retail outlets. But credit risk is running through the entire chain. How do we re-engineer that and minimize the need to have so many fiscal inspectors on site? Can we deploy a lot more ATGs to our tanks and have a lot more remote management? How do we automate our operations at the gas stations? How do we automate a lot more of our operations in our various depots to minimize the need of fiscal engagement? You go to a beautiful depot from a storage tank farm somewhere in Norway, and a huge one, and the staff size you practically may see there will not be more than 10. But you get here, and
you have about 2 minutes to round up.
Don't worry, I need just one.
Okay.
And you just have us right here in Africa overstaffing our facilities. Remote management and leveraging the fourth industrial revolution is what's going to be critical in our ability to survive and thrive and go into the future. AI, trying to specialize our services to our customers, is something we must consciously adopt. But the future is here. As W. Gibson said, it's not evenly distributed. We need to take our rightful place as Africa. We need to take our space properly by taking advantage of COVID-19 to prepare right and thrive in that future. A number of things put out here for us. We think blockchain for our credit risk management, apps and artificial intelligence for our customer management, digital trading platform for us to trade amongst ourselves across West Africa. Automation in our virtual operations becomes critical, and definitely digital payments. There are a lot more that we could look at, but we need to plan and prepare for the future and not just respond to COVID-19. Thank you.
Lawan is here now, and if he's ready to make his presentation. If not, we'll quickly jump to Mr. Avafani Shifularo. If you can kindly come on stage, sir. Thank you.
Good afternoon. I would like to request the administrators to put my slides on the screen. Thank you very much. Thank you very much, OTL, for inviting SAPIA, the South African Petroleum Industry Association, to participate in this conference in this special year where we are battling with the pandemic. Indeed, we are honored to be part of this event. All protocols observed. Can we proceed to my first slide? Just a bit background information about SAPIA for those who are hearing it for the first time. SAPIA is the South African Petroleum Industry Association. It represents the collective interest of the South African petroleum industry. We play a strategic role in addressing a range of common issues relating to refining, distribution, marketing of petroleum products, as well as promoting the industry environmental and socio-economic progress. Next slide, please. Just a bit, about industry. I'm sure it will be similar to your own, countries as well. The economic contribution of the petroleum industry cannot be underestimated in any country. So it's the same in South Africa. If you look in terms of economic growth, the contribution by the petroleum industry. Granted, these numbers are based on the figures that have been provided by SAPIA members, but they represent probably more than 95% of the industry in terms of the activities in the South African economy. Approximately 9.9% is the contribution of the sector to the South African GDP. This is based on 2014 figures. 65% of this, it will be attributed to the refining sector. So it shows that, refining industry is very critical in the functioning of the economy or the industry as a whole. Around about $8 billion spent on supplies. So you can see that, we support directly and indirectly many businesses in the economy. 18% of South Africa's primary energy needs provided by liquid fuels. This is quite a significant number, considering people when we talk about energy needs or all about power industry. But if you just look at the liquid fuels, the 18% is a high number. Roughly 10.5 billion US dollars, is the total value added by the industry based on 2019 figures. If we look at the investment, we spend roughly 2.4 billion US dollars in investment, and this is based on the period of 2015 to 2019. And then in terms of balance of payments, if you look at the sector, roughly 70% of the South African imports are crude oil and petroleum products. And so we are in the top 10 of the imports of products into the country. And when you look at the contribution into the fiscus, into the public finances, 9.1 billion US dollars on duties and levies is collected by SAPIA members on behalf of government. That's based on 2019 figures. And then the job creation and skills development. This point has been touched upon by my predecessor earlier on, Mr. Hossi. The industry, it plays quite a critical role in terms of job creation and skills development. So even though most of the jobs are not direct, but there are so many jobs that are related. So we estimate that if you look at the direct and indirect and induced employment, and roughly 50,000 jobs are supported by the liquid fuels industry. Next slide, please. Let's turn to the pandemic, which 12 months ago, we were not even aware that we would be in a situation where we find ourselves now. But based on the figures that we've just borrowed from the International Energy Agency, those graphs, you find there, you just see, worldwide, the pandemic has really caused unprecedented demand destruction. We've heard the experience from Ghana. I would like to believe it is the same experience for people in Nigeria and elsewhere in the continent and in any other corners of the world, of the globe. This demand destruction is reflected in cuts in crude runs worldwide, with significant stock builds of total oil stocks as the demand was falling. The refinery margins were significantly impacted, turning negative around April, May, and they've stayed in this territory since. Remember, these are the months where we were globally pretty much on hard lockdowns, and the demand for products was almost reduced to non-existence. So given the petroleum product demand, markets are expected to be under severe pressure for the foreseeable future. And in South Africa, also this is very clear. And if we look at the petrol demand, which is, today it's approximately 20% compared to last year. So we have recovered, but not back to the so-called normal. Next slide, please. Let's continue on the impact of COVID-19. I mean, again, if we look at what is happening, across the globe, you could see that the issue of survival, especially for smaller players, is becoming a real issue. High-cost refiners will suffer. I mean, most of our refineries in the continent, they are, small in comparison of new modern refineries, and they are probably, battling, the current, low margin, environment that we are facing. Again, faced with the challenges of moving to cleaner fuels, this is just make the whole thing, quite, a cocktail of challenges. But utilization is expected to be cut due to both the demand and poor margins. Investment expected to be cut. Any slack will see advancing plant maintenance activities. Globally, rationalization is expected to, with 1.4 million barrels per day capacity under threat in Europe. Measures likely to sell more downstream assets. Portfolio adjusted, expected to focus on modern, low cost and low carbon intensity facilities closely integrated with petrochemicals. Big companies likely to see decarbonization efforts accelerated because COVID has just made everything, more possible, or we given us opportunity to fast track some of the long outstanding, actions. South Africa is not immune from the large global trends and expect increased pressure for acceleration to cleaner fuels, to cleaner energy sources, which includes the provision of cleaner fuels and cleaner electricity. We are experiencing pressure in South Africa from trading partners at the non-governmental organizations, especially those that focus on environmental issues. Next slide, please. I think this is a available information about transition. This evidence that transition is already underway. If you look at what BP has been reported to be saying, that the world is not on a sustainable path, needs a rapid transition to lower carbon energy in order to meet goals of Paris Agreement. Our own local company, Sasol here, they indicated they've made clear portfolio choices that will enable Sasol greenhouse gas emissions reduction ambitions and ensure a future that is sustainable on the long term. Shell has set itself an ambition to become by 2050 or sooner a net zero emission energy business. Total, they say together, let's speed up energy transition to create carbon neutral society by 2050. You can see everybody is really looking how can we transition, we reduce our dependence on fossil fuels going forward. Next slide, please. So back to South Africa. If we look at the mobility transition, and this graph is based on the work that was done by various stakeholders in the liquid fuels sector in South Africa. If you look at the transition, it is going to happen, but it's unlikely to be quick in the case of South Africa. Reason being that the electric vehicle costs are high, unless if there are changes to make these EVs more affordable. Those changes could be via the tax policy, but this is unlikely to be the case in the short term because government is under pressure to really increase their revenue collection. And the move to EV is going to have impact on employment as well, especially on the aftermarket, the spare parts and maintenance shop. Slow vehicle turnover, vehicle turnover of the current car park. Currently we estimate that we sell 540,000 units per annum. These are not only vehicles that are sold in South Africa, include exports. So all in all, we've got a 12.5 million vehicles on our roads which are registered. So if you work on that basis, you would assume that the vehicle turnover is around 23 years. So you can imagine that one vehicle, it will last for many years. So in order to really cut that period short, you need to make EV more affordable. So this is the transition will need to take into account of the duration it takes to turn over vehicles, and also to take into account cleaner fuels driven by OEM technology. Let's move to the next slide, please. Let me just wrap up. If we look at the South African liquid fuels industry, like in any other industry in your countries, it is an important contributor to the South African economy. The COVID-19 pandemic has caused significant demand destruction, affecting refinery margins worldwide and driving transition. The oil or energy majors, as they are now rebranding themselves, are focusing on less carbon-intensive assets in association with petrochemicals. South Africa is not immune to these changes, but the motive energy transition expected to be slower, market rigidity, economic outlook. But transition to cleaner fuels will likely accelerate by OEM technology demands and consumer preference. SA opportunity lies in the cleaner fuel space, creating the space for advanced vehicle technologies, sustainability of local refining, and adaptation of new normal.
Thank you very much. We really appreciate that. That was very insightful, all the way from South Africa. I don't know if Mr. Onuwa Wire is on now. I can't really see him. If he's not, we'll move to the CEO of Adova PLC, Mr. Olumide Adeosun.
Okay, thank you. What I'm hoping to do over the next 11 to 12 minutes is just to share some insights into how we sort of personally managed COVID using technology, and then sort of give some indication of where we think we will be going next at a very high level. First, I'd like to thank the first two speakers because they really kind of came up with a lot of data that I think has helped to set the context very well. So what I'll do is I'll talk to you how we managed. So in Q1 2020, the most unexpected happened. There were three sort of big things that happened. The Saudi-Russia price war already depressed the going rate for crude oil, suppressing the market. Then we had the US-China trade war. And then the last thing we needed, a global pandemic sort of kicked in. At the time we became aware of it, about 11 million people had been affected globally. I think today we're looking at in excess of 40 million cases globally. So for us, that was already plenty to take on. And on the 19th of March, there was a price change that happened within the downstream. The price of PMS was dropped by a further 20%, which presented a margin challenge in itself and some operational difficulty. So we were really kind of stuck between a rock and the hardest place. But what we did was we had been working on a BCP, a business continuity plan. So what this did, as it did for a lot of other aspects of our business, was it forced us to bring all of our plans and aspirations that were plotted for later in the year forward. We basically activated a BCP immediately. We created a war room, a virtual war room that had all the heads of sales and departments for the various products in one space. And we really sought to delayer the organization very quickly. The big impacts that we saw in the market was, first of all, there was a marked change, immediate change in consumer behavior. The previous two speakers have talked about demand destruction, but really we saw it live. The aviation business fell on its face overnight. We could not sell a drop of jet fuel. Total lockdown also meant people were not moving cars. I remember I had my car parked and literally I didn't have to buy petrol for the entire duration of the lockdown. So all of this collided to kind of change the way people were behaving, something we had not planned for. But we recognized that actually there was a price to be given for quick decision making and very flat organizations. We immediately transformed our workforce. We all started working from home. We had started to make some investment in technology, but we weren't quite there yet. we had begun a laptop refresh. As fundamental and basic as it sounds, it helped because a lot of the machines that we had before were not able to function properly. And then lastly, we noticed that even the regulatory bodies that are traditionally slow to react were very nimble. We saw the SEC come up very quickly with some guidelines around remote AGMs and remote board meetings. We've had a remote AGM and we've had a remote board meeting. We're about to have one this week. So all of these behaviors meant that we as a company had to really manage the way we were entering this uncharted territory to make sure that we did not absolutely lose everything in the process. So for us, we use technology as the baseline, and the technology that we sort of deployed, the technology buckets that we deployed that helped us really was one moving to the cloud. As a business, we had historically stored quite a few things in localized servers, but as part of the move to Office 365, we had moved to the cloud. That helped because it meant that we could decentralize our data points and everybody could access data and information from anywhere. In terms of collaboration, we found that actually Teams became the #1 application that we used. We created virtual rooms where we were able to record meetings, and people were actually able to increase their productivity over that time. And lastly, we looked at data analytics as a way of getting better insight into how badly our numbers could get. We had modeled some stress tests on our P&L, so we tried to figure out what the next quarter would look like. And as part of that process, I had written to my board to say, look, we think we're going to have a depressed cycle coming up, depending on how pervasive the lockdown gets to. But we found that across the 5 thematic areas of our business, we were able to deploy these three technology buckets. So for us, the big areas are sustainability, making sure that we have a business that can withstand anything and is around for the next 50 plus years. Brand and service excellence, making sure that we are able to provide world-class service to our customers, regardless of how they interface with us. We are focused on making sure that our core assets, our stations, our terminals are maximized in terms of their usage, so that the return on investment we're getting is as high as it can be. Our people, of course, are our greatest assets, and we need to make sure that we're able to collaborate with people we're not able to see each other every day. And that we could not control every single solution or envision every single happenstance. So it was very important that we had partnerships with best-in-class companies that are able to provide synergies and help us create value as we navigated through this unprecedented pandemic. And then once we sort of got over that phase, once we got over the shock of having to change the way we worked and having to adapt to new expectations from our customers, we started to try to normalize this new normal. All right. So basically, we wanted to make sure we continue to make sure that the adoption to technology for all of our support staff was 100%. We continue to roll out new work tools to people, and we continue to make sure that the people who were actually working in operations were also able to use technology to basically perform their duties in a way that's safe. So some of the tactics, rather than strategies we adopted, was making sure that, as I said before, every point of contact moved remotely. We created various groups that we didn't have before, and we had different people actually working in spaces that they were not necessarily working in before, and that created a multi-homed or multidisciplined staff. So we built some capability in the process. Centralization of our data in storage meant that centralizing our data in the cloud meant that we were able to have access to it at all times, at all places, and from every single location. We also made some investments in making sure that we could secure the way people were accessing data. And we continue to use analytics to check in on how how the work we're doing was actually impacting our P&L and our bottom line. Other tactics we adopted is same with I think with many other organizations. We basically flattened our organization. When the lockdown period was over, we still didn't resume fully. So again, we just took the opportunity to continue to strengthen our remote working capabilities to great effect. And as much as I enjoy having people working in the office, it was really something to see how adaptable our teams were in terms of using remote working to make sure that our efficiency really did not drop, and this came through in our numbers and our performance. The volumes were down. We were still able to run the business in a way that meant that the impact was not as bad as we foresaw it. So in the use of technology across our operations, it helped us to make sure that we on things even though we were not able to physically. And so I'll just walk across the things that we did in that we worked on that really came into was that we had started the process of greening our stations. Greening our stations. One of the things that helped us was that we had pilot solar on, and to have these stations be able to switch on and off between the grid and the solar was in a seamless way was very useful, and made sure that we're able to run our operations continuously. The work we're doing at the station, we had done some, we were piloting some remote technologies. Somebody had mentioned ATGs. We had looked at putting sensors, we had sensors in pumps and probes in tanks, that we were able to have eyes again at the station as though someone was there, being able to see right there what a particular station was doing in terms of volume across the product lines in each tank was particularly useful. And a direct consequence of smart station deployment was that we really got to understand use and behavior pattern, not just from our dealers, our dealerships, but also from our customers on a pump-by-pump basis as well. We also looked at making sure that the insights we were gaining from this deployment of technology was something that we were also tracking to make sure that the insights were not just data that sat somewhere, but we try to make sure that we're using them to understand our business properly, so that we're running a much more effective utility. And lastly, because we were all sort of we're all kind of working a bit more remotely, a bit unhealthy, but we found that we had a better interface across all touch points with our customers. You didn't have that situation where a customer support agent couldn't answer a customer's call because they were driving in the car. So again, all in all, that technology was really the means to overcome the very or potentially very adverse effects of the pandemic. Now, for us, we also saw that yes, on the one hand, it's important to be defensive, watch your cash flow, put the handbrakes on spend, but we also use the opportunity to actually advance some more of the technology. And like I said before, we brought some of these technology deployments forward. So I will just talk through a few of the things that we'll be looking at over the coming cycle that will enable us, I think, provide even better quality of service to our customers. So the first thing that we are looking at doing is that we will continue to push the mobile solutions. We'll continue to push the envelope. One of the speakers, I believe it was Mr. Hosi, who said that it was important that the customer engagement or customer self-service is key. So that when we want to make sure that we're able to converse with our customers through their chosen interface, be it WhatsApp, via our apps, via websites. We want to make sure that we are able to actually converse and communicate with them. So to that end, we are also looking at making sure that we're able to provide last mile service to our customers. The way we do it is by moving a few more things that we did not traditionally have accessible via an app into an app. During lockdown, I think it was we did not have that many people coming into the station to pick up a liter of lubricants or anything like that. But the fact that we move these things, the sales points to an app or to the cloud, means that a customer can still play the chatbot, and then the onus is on us to make sure that we provide that last mile capability. The next one, we are going to look to really leverage AI, specifically chatbots. What we're going to do here is to make sure that, again, we are able to provide fast, cheap, or low-cost support to our customers for their very obvious requests and requirements. It's not everything that requires an expensive human being to do. The range of services we offer as a business are finite. So we believe that there are some things that a bot can actually do, and we're trialing that now to see that that's the case. So we'll be looking to push chatbots across, again, some of the customer touch points we have. Lastly, we are going to push a digitized loyalty scheme that ties into some of the other services we provide. So either the retail services or the forecourt services around fuels, such that our customers are also able to get the benefit of their loyalty to us by way of redemption, or by the way of being able to redeem points in exchange for more services.
Thank you very much, Mr. Adeosun. Brilliant presentation. But in order not to take too much time, we'll just go into the question. Okay, my first question is for Mr. Host, because you discussed the possibility of the fourth industrial revolution and how COVID-19 probably spurred that. In a fourth industrial revolution, there will definitely be a different energy mix from what we currently have. And they also mentioned in your presentation that as a result of COVID-19, there is a severe asset underutilization. How do you think that all will be able to, can we come into our
things? Thankfully, COVID has shown us a bit of the future. So let's move out of reacting and being proactive of this obvious present future. And that needs us to strategically position ourselves right. We're already remote managing. We have to invest a bit more in technology to get that done efficiently. And once you invest in a bit more technology, it gives you a bigger management span, because you can be at a lot of places almost at the same time, within the same period. So you can actually control and manage things much bigger. So that should give us a clear window that there's better value in us looking at mergers and acquisitions and opportunities for competing other than competing. Thank you.
Wow. Mr. Hosi, that was fantastic. I didn't even expect that the answer would go in that direction. I like the fact that you mentioned collaboration, cooperation, and in particular, I particularly like the word competing as opposed to competing. I think, to be honest, I think that is really the future. All marketing companies need to look inward and need to work together as opposed to working in silos. Thank you very much. That was a very fantastic answer. I don't know if Mr. Lawan is respond now, and if he's ready to make his presentation. If not, I'll just jump to the next question for Mr. Fani. All right. In your presentation, you had mentioned transitioning from big fuel to big energy, that it is basically inevitable. We have to move, whether we like it or not. And I think Mr. Hosi also addressed a big part of that. How can oil marketing companies scale value in a transitional industry? Because now we are not doing we're not going to be doing what we are used to. We're going to be transitioning. So how do we scale value in a transitional industry?
Indeed, Mr. Hosi has already touched, responded to this question, and I indeed agree with him that if you look at government policies around the globe and international agreements, whether you are looking at the UN, they all point to a direction that we are required to be less dependent on fossil fuel. But all the so-called international oil companies, they are rebranding themselves now. They are now want to be known as international energy companies. Clearly, if you look at the trend and the way people are behaving, is that energy transition from big fuel to big energy seems inevitable. It is already underway if you look at what we're being told. If you look in particular in Europe, a lot of the majors are already undertaking a shift, calling themselves energy companies rather than oil companies. So in the future, they will prefer to be called as international energy companies as opposed to IOCs. The way in which one is tackling the transition is different. If you look at BP, for example, has publicly stated that they will focus on low carbon energy and resilient and focused hydrocarbons. That is more competitive production with no new exploration in new countries. Total, on the other hand, has stated that they wish to be net zero by 2050 and have already progressed in this respect by reducing exposure to oil from 66% in 2015 to 55% in 2019. What is becoming clear is that gas is seen as an important intermediate energy carrier for them as a transition occurs. So yes, it appears based on the actions of the major players, whether those are regulators or the operators themselves, that indeed we are going into be less dependent on fossil fuels going into the future. We better get used to living that way. In other words, be mindful of the carbon footprint of our activities, whether in the sector or as individuals. Thank you.
Thank you very much, sir. In fact, I think it's the world we live in. We're not just living in it for us now, we are living in it for the future generation as well. So we need to keep things clean. We need to transition with what is going on and ensure that, fossil fuels is to an extent, this is our industry, but we all need to move into energy for real, not just oil and gas. My next question is for Mr. Adiosun. I was very excited looking at your presentation and everything about from home and the disruptions and everything. The truth is, as a result of COVID-19, there have been disruptions that have led to changes in consumer behavior. Now, the typical downstream customer now has different expectations from what they had prior to COVID-19. And you had mentioned that Adova, for instance, would employ artificial intelligence such as chatbots and all of that, to address the new consumer behavior. Do you think that these AI, these chatbots and these really, artificial intelligence, do you think sufficiently address the need with customers, where you're not addressing one-to-one anymore? It's a computer that's doing it for
you. No, I don't think AI on its own is the correct response to serving the customer in a much more digitized and open world. I think chatbots really are just one tool in a suite of. Again, the theme that has come through some of these conversations is that as a direct consequence of COVID, we have also had to look at our staff numbers. We can no longer necessarily afford to have warm bodies service every single request that comes in. And I think AI technology such as chatbots is really just it's a gateway to the world of possibilities. I mean, one of the things we still haven't explored here in Nigeria, for instance, is, and I know there's many reasons why, but I think in time, even that will become a thing, which is we haven't looked, we everywhere else in the world, there are many, many unmanned filling stations. I was in the Netherlands in January, and I saw a filling station that was literally 2 pumps in the middle of the road with nothing else around it. And I mean, immediately I started wondering how they even took deliveries, but apparently even the deliveries happen without human beings. So self-service is, it's some sort of self-service at a pump. It's another one of those. It's another one of those ways. So I think chatbots are really just one very small example of how far self-service can go. It is very possible for me not to get a carton of lubricants at home without actually talking to anybody. This has been around for as long as the e-commerce has been. So I think that, yes, there's a lot of exploitation of technology that's going to happen. And as much as we think that it doesn't necessarily apply here, I think there'll be a prize for the company that starts to look to solve some of our very common problems, not just for themselves, but really for deployment across the industry. So I do think technology have a much, much bigger role to play in the future of the energy business.
All right. Thank you very much. It's comforting to know that we won't just be dealing with robots. Mr. Hosi, just a follow-up question. You had mentioned in your answer that there are bleaker prospects with regard to clean fuels today because of COVID-19. But we need to still move to clean fuels. Is all hope lost?
I won't say all hope is lost, but we're looking at our refineries building capacity to invest in cleaner fuels, the existing refineries. Say for Dangote, who would actually be the biggest salvation in this discussion because of their low sulfur infrastructure. Because when the refinery is up, it will be producing low sulfur diesel and low sulfur petrol. You don't have that across the West African region. You need to have good margins, at least in between time, to be able to build a base to make the right investment in these infrastructure. But as refinery margins really get smaller, it becomes quite a challenge for most of these refineries to be able to make the right investment. And that's why I say the prospects of having our refineries produce it has become bleaker. But it's not to say we can't move into cleaner fuels. We can. Cleaner fuels in Ghana today, most of the fuel consumed in Ghana are low sulfur or ultra low sulfur fuels. It's a matter of which production entity will drive it. Will it be local production or it will be driven by foreign production? If it's foreign production, that capacity exists today. But that also comes at the expense of our ability to process our own crude in Africa. And the demand direction is headed towards Africa, because as cleaner fuels, engulf a lot more of Europe and the West, and fossil fuels also depletes in the dependence, it will take Africa a while to really catch up. What we have to do is make the right investments, and we need to invest in our own people to drive for that future. It's going to be heavy on governments, because most of our refineries in West Africa are owned by government, but that's a call that governments would have to make. Other than that, it behoves on us as private sector to invest a lot more in Dangote by patronizing their products as much as possible, making sure Dangote gets the right returns, and then he can expand capacity to feed broader Africa.
Absolutely. Thank you very much. We have a couple of questions for you from the audience. The first question is from Mr. Emeka Akabogo. And he said, from experience in Ghana, what's the relationship and relative operational incidents between oil majors and independents within the oil marketing segment of the market?
Could you repeat the question?
What's the relationship between relative operational incidents between oil majors and independents within the oil marketing segment of the market?
Okay.
You are not in Nigeria, and if you were, I would have said that's like a jam question, but
it is still a jam question. I was born and partly bred in Nigeria, so
I
can relate to jam. One, our market is not structured like you have in Nigeria, where we will call some group independents, and then the others oil majors or movements. We don't have that kind of structure, but every market still has a bit of a swing to a certain group of people. So if you look at the oil marketing segment, you possibly have maybe about some big five who control a very significant portion, maybe over 50% of the market. So in this case, probably I'll relate to them a bit as the majors in this conversation. But almost everybody, except for only one entity, is an independent in the technical sense of the term. But operationally, relationship, so you don't have much of relational incidents with Ghana. What we have is a structure that has a group of people, licensees called bulk distribution companies, who actually feed the oil marketing companies. Now, the oil marketing companies in Ghana are a subset of the oil marketing construct in Nigeria. So in Ghana, the oil marketing companies only buy tank farms or depots. They do not buy or import like you have Sahara, NNPC. No, you don't have that. Not at all in Ghana. You have a group of people called bulk distribution companies who stock our tank farms, own these tank farms in some cases, and then break bulk to oil marketing companies. That's the structure you have there. What you've seen in these times is a lot more edge towards integration and vertical integration. We have not seen much of the competing that we see. Some of the competing that we are looking at least on the bulk distribution side or the importer side. We've seen a lot more importers looking at co-loading. First, you actually have a single importer importing a product and importing things like 33 KT at a time. But what you rather have now is a lot more co-loading. So you see a vessel of 33 KT or 40 KT coming into this market and possibly has about 5 or 6 companies on it, sharing the risk and also minimizing the logistical cost on them. It also helps them with their stockholding, and those are part of the recommendations we made earlier. So to directly answer the question, the market structure does not legitimize the question.
Okay. I'm refraining from saying that's a political answer because you've gone around and discussed everything and then come to the conclusion that there is no answer. Thank you very much for that. My next question is to Mr. Avafani. You said that margins have been severely impacted. In fact, we all know as a result of COVID-19 that, margins are so thin, they are almost not there. Is it possible to estimate a recovery period where margins will be close to pre-COVID times? I'm not asking you to look, but can you, figuratively look in the crystal ball and tell us when everything is likely to be normal?
Yeah, that's a very difficult question. It's like asking me where is the Naira going to be to the US dollar in 6 weeks' time. It's quite a difficult question, but I will attempt based on what we know. At this stage, it really is very difficult, to make that prediction because there's a lot of factors that need to be considered. But in the first place, liquid fuels demand, as we have heard from other speakers as well, has been severely impacted all over the world, leading to the overhang of finished product and crude stocks. And this has direct impact on margins and also has caused significant refinery cutbacks. So if you just look at other reported information from the price reporting agencies, they suggest 1 million barrels of refining processing capacity is at risk in Europe of closure. What is certain is that there will be a shakeout of processing capacity in worldwide with at least efficient refineries in free market, at least efficient refiners in free markets closing. So that's the first part. Secondly, the long-lasting effects of pandemic and how this may change the way we operate. We may work from home and virtual conferencing, which will have lasting effect on transportation fuels demand, specifically petrol and jet. We've heard that jet, because it's really linked to tourism sector, it's almost dead. There's no jet fuel sales that are happening. Thirdly, the other point that we need to consider is that the energy transition. It is very critical when you talk about the issue of margins, where margins are likely to go. There's no doubt that working from home has impact on the demand of oil products. And this on its own is accelerating energy transition. And if you look how the international energy companies or the so-called, previously IOCs, they've responded by reducing their exposure to risk assets. They started to reduce headcount, and they're now reconfiguring their portfolios towards low carbon products, which includes gas and chemicals. This on its own has an impact on further reducing our dependence on fossil fuels, thereby influencing the direction of the margins. Fourthly, another factor that we need to consider is that in the immediate term, I'm talking about 6 to 6 months, the various economies around the globe are going to recover at different pace. Whether the second wave will result in another significant lockdown, this has got serious impact on the petroleum product demand. And what is clear is that, another lockdown will push the recovery out another number of months, and that will have direct impact on the demand, thereby impact on the refinery margins. Finally, to try to answer your question, if all of the above happens, we can likely see a second wave of rationalization, which will shake out some of more players until some type of equilibrium is re-established. So in the case of my home country, South Africa, where we still have the international oil companies, that picture might change and we end up with a picture similar to what we have in Ghana. So there's a lot of things that needs to happen for one to be able to say this is where the margin is going to be. One thing that's clear is that we are not going to see pre-COVID margins in the medium to short-term period. Thank you.
Wow. I don't want to say that is a bit puts a bit of a damper in our mood, because it's not looking like 2020 or 2021 or anytime soon. But we have to keep we are optimistic. We know that the market will come back, even if we can't predict now, but the need for energy would always be there. So my next question really is for Mr. Adiosun. Again, I'm back to working from home. And the reality is, I think that working from home catapulted employers and employees into the future, because people have been talking about flexi working for donkey years without actually doing anything about it. I think a lot of employers were reluctant, really. But then we are where we are now, and then you have to work from home. However, there are real vulnerabilities in information security. And sometimes, confidentiality of data, staff work remotely can be compromised. Maybe you're attending a board meeting remotely, or you're attending a management meeting or some other important meeting. You have guests that you can't say, get out for now. You leave your system, and then there are also the vulnerabilities attached to gateways and all of that when you use an internet service provider that is not as secure as you would have gotten in the office. How do you balance the benefits of remote working and this possibility of compromising the company's confidential data?
Good question. So I have a small background in information security. The truth is that it's sort of, so I think I'm going to extend your question to say, how do you balance not just the benefits, but the necessity, right? So we almost have no choice in the matter. People have to work from home. And so what we have to make sure is that, and there will always be inherent risk. So what we have to do is make sure that we are balancing the risk in the sense that the protection that we're offering is not much greater or more expensive than the data or asset we're trying to protect. So it's going to be a multifaceted approach, right? The first thing you need to do is you need to make sure that your staff, your employees, your trading partners, your communication partners are all aware of the risks. So your first line of defense is actually the individual. So some of those practices you just mentioned. I prefer people not to travel too often with their laptops, right? I prefer people who are working at home with their kids not to leave their laptops unattended. Even with the best will in the world, damage is the thing. So it's a very clear risk, but it has to be done in a multi-layered way. You talked about the gateways. You need to make sure that people are communicating to the extent possible from behind firewalls, that when you're accessing a very sensitive piece of information, that information is classified so that the protection you wrap around it is also commensurate. You use a VPN to make those communications. You have a list of router addresses. So it's a combination of technical, but really it's a social that's much more at risk. And there are all sorts of professional cyber criminals out there. It's not uncommon now for entire databases to get hijacked for ransom, right? It happens every day. Both at an individual and at a personal level. So I think education is the most important thing. You cannot go home with every single employee, and you cannot consider every single possible safeguard. So really, it's really down to raising the awareness within your organization, making sure that there is some sort of compliance, some sort of monitoring, and making sure that you kind of also put some sanctions in the event that there has been a willful or very obvious neglect to follow your information security standards or policies.
Thank you very much. I think I'm satisfied with your answer. But we have a couple of questions for you from the Q&A.
Okay.
There is an Oluwaseun Abioye who has a couple of questions. So I'll just read out the questions he has. I think he has 2 questions, and I think they are directed to you. He said, hello, wonderful presentation, sir. My question is, to what extent do divestment of oil majors and takeover by independent affect the petroleum oil marketing? That's the first question. The second one is, to what extent do divestments... Okay, it's the same question. He just read.
So that question was, to what extent do divestments of oil majors benefit, or what's the question?
To what extent do divestment of oil majors and takeover by independents affect petroleum oil marketing?
So I'm from it's to the trend we've seen, where a Mobil exits, a double one takes over, where a Chevron exits and MRS takes over, that sort of thing. Honestly, I think from the majors' point of view, they will be exiting a low margin environment. So if you think about most of these, the majors, their investments will have to be fulsome and 3-dimensional. Now, I'm not suggesting that Nigerian companies are less safety conscious, but they will do it in a particular way that is more consistent with how you would do it in the West. In some cases, that might also be overscaled. So their cost of running those assets are probably greater than what a Nigerian owner or indigenous owner would do. So I think that the divestments are inevitable. I think we're going to probably see more of it. But it benefits us because it means that we're actually able to build a lot more capability. We'll hopefully inherit and continue the safety standards that they've established. And for us, it's really, and I heard one of the speakers say something about this, and I think we've really got to stop thinking, for all of us, we've got to start thinking beyond the sales of fuels, right? These things are called service stations all over the world because actually it's a place you go to access a plethora of services, some of which have nothing to do with hydrocarbons, right? Shell will tell you that they sell more coffee off one of their biggest flagship stations than they do petrol. And to be fair, they probably make more money off that as well. So, I mean, I think it's, I think the impact can only be positive for us as a country. And I think it's incumbent on every indigenous player that takes over these great assets to make sure that they'll run them in a way that's sustainable, and that they think about how best to diversify the proposition to market so that they're really serving the needs of the communities they operate in.
Thank you for that response. I have another question from Chukwu Nonso Ude, and he said, Mr. Olumide Adeosun, do you think that fully integrated oil marketing companies face higher risk during recovery from COVID-19 compared to their single-oriented counterparts? I think he's trying to compare majors and independents.
Is it that, or is it majors and independent downstream, or is it?
Yes, it has to be downstream.
Okay, so, or is it OMCs versus, say, like bulk and wholesale people? Well, I mean, I think in any event, if your business is entirely dependent on hydrocarbons, on fuels, then you are more exposed because you're keeping all of your eggs in the same baskets that are all exposed to the same risk of cracking, right? If you are a downstream business that might be integrated, so you're working from you have a marine capability, you have terminal capability, and you have last mile distribution and marketing retail capabilities. I think you're still exposed to the same risk unless at the retail end and at the terminal end, you're able to offer other services. So for instance, if you're a terminal owner, you're making some revenue off throughput. We know that's nothing to write home about, but there's something in it. So even other people are paying you to use your facility. And if you're a retailer, then you are in a position where you are at least able to sell other backcourt services and products to the market. So LPG, for instance, is facing a completely different kind of stress than, say, petrol. Over the lockdown, I'm not sure that any LPG person said, hey, you know what, my LPG sales has completely declined because people are no longer eating. But I think certainly all of us that were trying to sell jet fuel were certainly not saying that same thing. So I think it's really more of the diversification of your portfolio, your product offer to the market, rather than whether or not you're integrated, unless I've misread the question or misheard the question. So I think really it's more about how diverse is your portfolio, what do you offer in the market? If it's all hydrocarbon, it doesn't matter how integrated you are. That's my view.
All right. I think this is the final question. It's from Awal Dewa. He hasn't directed this question at anybody, so I'm just going to throw it at the panelists. Everyone can have a shot. He said, how do you scale value for oil marketing companies in markets almost totally controlled by political elites and government? And then he came down to say, talking about product importation, access to forex, government price control, and licensing issues. So thankfully, he hasn't addressed it to anyone. So I'm throwing it to the floor. Meanwhile, Mr. Chukwunonso Ude has responded and said he's very grateful and have answered this question appropriately. Anyone willing to talk about access to forex, government price control, and licensing issues?
Sorry, I didn't get the question in full.
Okay, the question is, how do you scale value for oil marketing companies in markets almost totally being controlled by political elites and governments in relation to product importation, access to forex, government price control, and licensing issues?
I mean, I can take this. It feels like it's a Nigerian question. No, I think the reality is that the sole importer of products on account of what the marketing economic or what the product economics are right now is PPMC. Let's not say it's the government; it's PPMC. And the challenge most marketers face is access to FX. Because we obviously compete for market same as everybody else, and there are obvious and well-documented challenges with doing that. But I think anyone who's been tracking the news since the 19th of March will know that there has been a very loud and I think somewhat maybe concerted effort on the side of government to deregulate the market. My thoughts are that are aligned with that adage that says the best time to plant a tree was 20 years ago. The next best time to plant it is right now. So I say that to the extent that we want to have a forward-looking discussion, and to the extent that the government has said that it's going to deregulate the market, we have to take them by their word. But we ask as an operator, the prayer is that this is done as soon as possible and options are made available to market participants such that we can all access FX in the same way and be more right. Competition breeds. The pricing will breed the right pricing will breed competition. So I'm hoping that the government lives up to the being made, and we are not too far away from a universe where everyone and any player can access FX and can import or produce locally as they so desire. It also helps to have the right regulatory framework, so that starts coming to the PIB discussion. But I think they're all joined up.
May I please add to that?
Well, yes.
May I please add to that response as well?
Please go ahead, sir.
So we in South Africa, we are also in a price-controlled, market for certain products. Petrol, diesel, LPG, kerosene, and I think our experience is that as long as the rules, that governs that system that controls the pricing is transparent and is predictable, you can still, scale value for the oil, marketing companies. One of the biggest challenge or one of the issue that was exposed by COVID is that, in a price-controlled environment, the system is generally rigid. It does not have the agility built into the system in order to respond to the market that is responding so quickly. Just to give you an example, we went from a day of the announcement for hard lockdown, which was starting end of March, not knowing exactly what is going to transpire. But by day 3, already we realized that actually we can't move products by pipeline. Pipeline is full, refineries are just packed up with products. Jet fuel is going nowhere. So it's having a full-blown impact that has got impact on the cost of doing business. But the regulatory system is not geared to deal with such kind of pandemic. So we think we need to build agility and predictability in the system. And even though you've got a price control, it must mimic what will generally happen in a setup where the market takes full control of everything. Otherwise, it will work. Our experience is if you've got a system that's transparent and predictable, you can really scale up. The value, but you just need to know that the regulators. They need to understand the system, and there has to be trust between the players and the regulators in order for the system to be dynamic and still achieve the objectives that have been set right from the onset.
Thank you very much, sir. I have personally, I've learned a lot from the sessions, from the Q&A, from the presentations. I'm very delighted and happy to be here. Unfortunately, every good thing comes to an end at some point, and sad to say we've come to the end of the Q&A session. But before we go, we'll give each speaker or each panelist at least 1 or 2 minutes to just round up, your the key points you want us to leave here with regard to the topic. So again, we'll start from Mr. Hosi. Just a quick roundup of what you want us to leave here with today. Is Mr. Hosi there? Okay. Let's go to Mr. Vafani. We'll probably come back to him then.
Okay. I think we need to accept that energy transition is upon us. It's underway. The future is really more about energy provision. While the energy transition, the speed at which it's rolled out in each country will be different, but in our continent, in Africa, the transition, it won't be as quick as it is in Europe. So we will still need to make sure that we provide for the future technologies while we make sure that, we continue to support the OEM, technology that still require our fuels. So it can't be an overnight thing. As a developing, continent, there is still, a lot of scope for the demand for our products going forward. Thank you.
Thank you very much, sir. Mr. Hosi, do we have you now? Okay, if we can't reach Mr. Hosi, let's quickly Mr. Joshua.
Thank you. Thank you, Bumi. And so I think I'd like to leave on sort of maybe three kind of like thesis statements. The first is I agree with my colleague, fellow panelist. The energy transition is real. The rate of adoption might change, but the energy transition is real. And I believe technology has a big role to play in terms of helping companies scale and still be operationally nimble. I believe that companies that are able to think beyond fuels, beyond this sort of core fuels right now, and that pay more attention to customer touch points and making that as interesting as possible, and giving your customers more of a reason why they should choose you over any other provider is also quite vital. And the way you get to that point is by offering them what they actually need, more than what you're comfortable selling. The last point I want to make is that I believe the role of regulators and government in managing the transition cannot be understated. Regulations and policies is what is going to accelerate or slow down the pace of adoption. So we are at an interesting turning point now where we can either leapfrog, like we did in the telco. We are there. We can actually leapfrog because we have not necessarily made all the investments that other countries have. But if we fail to put the right policies in a joined up way in place, then it's very likely that we'll lag behind and we'll continue to lag behind. And then we'll be forced to confront the reality at a pace at which we're not prepared for. Thank you.
Thank you very much for that summary. Is Mr. Hosi there? Okay. If not, again, I want to thank the organizers of OTL, our esteemed panelists, the audience, the people who have asked questions, and those of you that did not ask questions. Thank you very much for your participation. Thank you for the time. It's been very enlightening for me personally. I've received a couple of comments here asking that the PowerPoint presentation be shared. So we'll try and I'll get in touch with the panelists and see if there is no proprietary information that will be disclosed as a result of sharing it. We'll do that. Thank you again for everything. We're very grateful for this panel. I think that indeed there is value to be unlocked in oil marketing companies. I don't think it's too late. And I think that despite COVID, that we can still make a lot, we can still derive a lot of value. And I believe strongly that if we really leverage technology, a good example, for instance, is even this conference that we're holding. Ideally, this conference would have been held face-to-face, all of us sitting, no social distancing. Well, we may have been socially distant a bit, but it should have been face-to-face. If you were stuck in traffic, then that's it. But now, I could very well be in traffic and attend the conference. I could be at home and attend the conference. I could, so I think that the more we try to leverage technology, the better we are going to be able to scale value, especially in this our industry where margins are thinning and everything isn't looking exactly bright. But there's hope for the future. So thank you very much. We appreciate you all. And with this, we have come to the end of the session.